In early May 2026, crypto markets were moving with a confidence not seen in months. Bitcoin had climbed above $82,000, and for the bulls, the upward momentum seemed established. This chart shows how quickly confidence evaporated. Over a few hours in the Asian morning session, Bitcoin fell to $78,000, erasing every gain from the previous week. It wasn't alone. Solana, Ether, and XRP were dragged down as the major cap market turned red. By the time the dust settled, more than $580 million in crypto positions had been wiped out in a single 24-hour window. This wasn't a balanced sell-off. 95% of the damage hit leveraged long bets, where traders had borrowed heavily to speculate on higher prices. When prices dipped, it triggered a liquidation cascade, a chain reaction where forced sell-offs pushed prices lower, triggering even more liquidations. Usually, a wipeout of this scale follows a major exchange hack or a protocol failure. But that Saturday morning, the blockchain was running perfectly, and the major exchanges were all online. The force that broke the market didn't come from inside the crypto ecosystem. It was the result of a fragile structure finally buckling under macroeconomic pressures from the physical world. While crypto was sliding, the S&P 500 was closing out its worst session since March. The tech sector took the heaviest hit, with the Philadelphia Semiconductor Index dropping 4% in a single day. The movement in stocks was mirrored by a massive sell-off in bonds. U.S. 10-year Treasury yields topped 4.5%, signaling that investors were now bracing for a long-term shift in interest rates. This wasn't localized to the United States. In London, the UK long bond rates touched their highest level in 28 years. Even in Japan, a global market known for low volatility, 30-year debt hit 4% for the very first time. This global bond sell-off indicates a massive repricing of risk. Traders who had spent months expecting the Federal Reserve to cut rates were suddenly shifting their bets toward potential hikes. That shift was driven by the data. Back-to-back inflation prints for the CPI and PPI came in hotter than expected, suggesting that the cost of living was not cooling as the Fed had hoped. Because traditional finance governs the pool of global liquidity, a panic over inflation in the bond market instantly drains the cash that sustains leveraged assets like Bitcoin and Ether. To find the source of that inflation spike, we have to look at the factors pushing up the cost of global trade. The primary driver was the ongoing conflict in Iran and the effective closure of the Strait of Hormuz. This is one of the world's most critical transit points for energy and goods. With the strait blocked, Brent crude oil prices settled above $105 a barrel. That increase in energy costs flows directly into the inflation data the Federal Reserve uses to set interest rates. The chain of causality is direct. A geopolitical bottleneck in the Middle East raised oil prices, which spiked inflation, which forced the Federal Reserve to pivot, which ultimately triggered the liquidation of $500 million in digital assets. The original promise of Bitcoin was that it would act as a digital gold, an asset that moved independently of the traditional financial system. The 2026 crash shows a different reality. Individual tokens can still see temporary gains from specific news, like when XRP jumped 5% after the Senate Banking Committee moved the Digital Asset Market Clarity Act forward. But those regulatory milestones are tiny ripples compared to the tidal wave of global macroeconomic liquidity. When leverage builds up in the crypto market, it creates a system that is highly sensitive to external shocks. It becomes a house of cards that can be toppled by a change in oil prices half a world away. If you want to understand where the price of crypto is going, the code on the blockchain is no longer the most important factor. Watch the shipping lanes, the oil rigs, and the central banks.